Maximize no tax on tips and avoid mistakes. With new U.S. tax laws allowing eligible workers to claim a deduction for up to $25,000 in qualified tips, you need to maximize the tax benefit arising from no tax on tips while avoiding mistakes. This federal legislation, effective for the 2025 through 2028 tax years, essentially creates a no tax on tips environment for many service workers by allowing this amount to be deducted from their federal taxable income. To claim this, you must be employed in an occupation that customarily and regularly received tips prior to 2025, a list that includes over 60 categories such as bartenders, servers, hairstylists, and gig economy drivers. While it reduces your federal income tax burden, it is important to understand that this is an above-the-line deduction, meaning you can claim it even if you do not itemize your deductions. To successfully claim the deduction, you must ensure that your tips are qualified, which the IRS defines as voluntary payments determined by the customer without negotiation. This includes cash, credit card tips, and even digital payments like Venmo, provided they are reported to your employer or directly to the IRS. When filing your 2025 taxes in 2026, you will likely use the new Schedule 1A, where you record the tip income already included in your total wages on Form 1040. The maximum deduction is strictly capped at $25,000 per tax return, so if you earned $30,000 in tips, only the first $25,000 is tax-exempt. Furthermore, the benefit begins to phase out for single filers with a modified adjusted gross income over $150,000 and for joint filers over $300,000. One of the most common mistakes taxpayers make is assuming that no tax on tips applies to all forms of tax, which is a significant misconception. While the federal income tax may be waived on these tips, you are still legally required to pay federal payroll taxes, Social Security, and Medicare on the full amount of your tipped income. Additionally, this legislation only applies to federal taxes. Unless your specific state changes its laws to match, you may still owe state and local income taxes on your tips. Failing to account for these ongoing obligations can result in an unexpected tax bill or penalties for underpayment throughout the year. Another critical error involves misclassifying service charges or mandatory gratuities as qualified tips. The IRS is very strict about the voluntary nature of a tip. If a restaurant automatically adds an 18% gratuity to a party of 6 and the customer cannot easily opt out or change it, that money is considered a service charge and does not qualify for the deduction. To avoid this mistake, you should carefully review your pay stubs and ensure your employer is separately tracking voluntary tips versus mandatory service fees. Claiming the deduction on mandatory fees could trigger an audit, as these amounts are technically considered regular wages by the IRS and are not eligible for the no tax benefit. To avoid documentation errors, it is essential to maintain a contemporaneous daily log of all tips received, especially cash tips that might not be recorded on a credit card statement. The IRS frequently flags returns where the reported tip income seems inconsistent with the industry standard or the worker's total hours. By using a digital app or a physical ledger to record every shift's earnings, you provide yourself with a paper trail that can defend your deduction during an inquiry. Lastly, ensure you have a valid Social Security number and, if married, file a joint return, as the law specifically disqualifies those who use an ITIN or choose the married filing separately status from claiming this deduction. We welcome you to subscribe to our YouTube channel for more informative videos on taxes, finances, and investments. Thank you.